So moving on to the last session of the day. The last session is with Mr. Sandeep Daga, who is the Managing Director and Chief Investment Officer at Nine Rivers Capital. Mr. Daga is one of the veterans in the space of small cap investing and has been successfully managing a fund which has delivered a CAGR upwards of 30% over the last 10 years. Let's hear from Mr. Daga on how to identify multi-baggers in the early cycles of investing. Welcome, Mr. Daga.
We have to start with a regulatory disclaimer. Past performance is not an indicator of the future. All the stocks that you see here, or if I talk about, are only for illustration purposes. It's not a recommendation to buy or sell. So, a little bit about us. We call ourselves as non-consensus investors focused on finding mispriced opportunities through our unique private equity approach. Me and my partner, before we set up this PMS almost 11 years ago, both of us actually used to do growth private equity investing. I did it for 14 years. He was already into private equity for 6 years, and prior to that, again, for another decade or 7 or 8 years in public markets. So we do believe that the private equity approach to creating and managing a portfolio of small caps, and we are exclusively small caps focused. So you've heard about all the risks since morning, and perhaps we are in the riskiest asset class when it comes to public markets. So we believe that the private equity approach, and I'm going to talk about it a little bit as we move ahead, is a very time-proven approach to basically generate superior alpha when creating a reasonably concentrated portfolio. So I am now, what Rajesh said, I'm completely going in the opposite direction. A reasonably concentrated portfolio of small cap stocks, and that leads to superior returns. So our strategy has delivered as on 31st of July, 29.1% CAGR. So what is this private equity approach? The private equity approach constantly pushes us to look beyond past numbers. So it's not about just historical analysis of the companies and anticipate the future of a target company overarched by positive industry or sector tailwinds. So that's what the approach mindset we carry each time we look at a sector, investment thesis, and then a company. What does our private equity approach entail? So we invest for the long term. Our typical investment horizon is 5+ years. So unless we see that our investment strategy is not playing out for fundamental reasons, or there are other issues that we see in any of our companies, we intend to hold our companies for 5+ years. We want to make most of the discovery premium. So we want to, like what happens in private equity, you want to catch up on an investment thesis earlier. And we have demonstrated this several times, through several of our investments. We'll talk about it. So if you go in early, you will get to capture the big discovery premium. And to go in early, to build that conviction when there are no research reports, when there is not enough information available on the industry, when industry itself is going through a transformative phase, you really need to go beyond desk research and take a plunge on the ground, so to say, and engage with the business's ecosystem. You start with building a strong investment thesis, and then from there you go and validate the thesis on the ground. So that's what we do. All these years while doing this, we have now built nuanced expertise in certain industry segments, and as they are changing, as they are evolving, we are able to keep on top of what's happening. We buy growth only at reasonable valuations. So again, we don't run a model portfolio. I'll come to our what I mean by reasonable valuations. We have what we call as our guardrail framework, price guardrail framework, where every stock which we buy is approved for buying. After it's approved for buying, it's only, there is a entry guardrail price that is assigned. That price is a function of the multiple that we want to pay to buy that business. And we will buy the price, the stock only if it is available on the market basis. If the price goes up, we will wait for those stocks to correct. If they just fly away, which by the way in our universe happens all the time, then we will not chase that company. We may have another, we are running a discovery engine. We may basically have another stock that will shortly get approved or is getting approved. That stock will feature in the newer client's portfolio. So it's very different from the routine that you see of a model portfolio where all client portfolios look alike. We create portfolio typically of 12 to 15 stocks, more tending towards 15, but we are even happy doing it at 12. So it's really concentrated portfolios that we create. And we invest to exit. So again, that same private equity approach where in a private equity fund, when you run a private equity fund, you basically create a portfolio of companies. You nurture those companies, monitor those companies, and then you have an exit goal and distribute money back to the, to your investors. It's the same approach here, but here it's at a company level. You invest in a company which is part of an investment thesis. You invest with the idea that you will exit. So the typical time frame we have to exit is 5 years. But markets being markets do have both irrational exuberance at times and needless pessimism at other times. So we would also, sometimes we may do an accelerated exit, if not a complete, maybe a part exit. And sometimes we have to hold on for another year and a half to get that optimal exit. So as long as companies are doing fine, we will continue to hold, but we have this flexibility with the average 5-year time horizon on our mind. What we look for in our investing companies? So we have, by the way, a lot that I am going to say has already been spoken by speakers earlier, but I just, please bear with me for some of the repetition because contextually it's very important in terms of knowing what we do. So large addressable, preferably in an oligopolistic market structure. This is what Rajesh spoke. So all our businesses are basically fit into that where we are interested. We look for a solid business franchise in a clearly visible mode. So wherever we invest, those businesses are leaders in their business segments. They are number 1, number 2, number 3 in a oligopoly of maybe max 5 players. We look for profitable growth. So we are not for mindless chasing of growth. Now, this is debatable because somebody might say that once growth is, then profits can come later. But we believe when you are only small caps focused, you want to see your companies make money, and that gives them the longevity in business and keeps building on their balance sheet strength. We want managements that have a good track record of execution. We look for operating leverage in most businesses we invest in. It could be both hard assets or soft assets that can be leveraged. Low to no financial leverage. So almost I would say 70% of our companies are absolutely zero debt. Not a single rupee of debt. I'm not talking of net debt. Zero debt. The remainder companies that are there in our portfolio, they are also very minuscule amount of debt. So highest debt equity ratio in any of our companies would be like 0.2, 0.25:1. And of course, all of this, when you have in any business, then those businesses generally generate healthy cash flows and healthy returns. So again, what is a typical anatomy of a classic compounder? So we discuss large opportunity size. Focusing on the core, when you look at a good opportunity, maybe I can take an example over here. So we were perhaps the earliest investors, professional investors in Alkyl Amines. We exited Alkyl Amines. We made 11x in Alkyl Amines in a span of 4 years. So we could see the entire, specialty chemical space. This happened because we were engaging. We could see the China +1 playing out because of the China plant closures in India. So we basically started meeting the companies, and what we realized is that this is complex chemistry. So core, as earlier somebody had said that there are only two companies, Balaji Mines and Alkyl Mines. So this is complex chemistry, goes into variety of industries. So the application is across different verticals, consumer, FMCG, pharmaceuticals, paints, I mean the whole bunch of industries they used to serve. So they are not dependent on one industry. And the company is only going into more value-added derivatives. So they were not trying to, they were cash rich. Vis-a-vis this, the other company had hotels business in their portfolio, and so the focus on the core is very important for us, because if there is an upside here, then the energy should be focused there. Scalability comes from the fact that there was this whole opportunity coming. And so all of these things, I mean, transparency and governance, we take a very, very serious look at governance. In terms of, there are some slides ahead, I just want to spend more time there, So oligopolistic structure, whenever there is, that's the sweet spot. Otherwise, sometimes there are these fragmented or highly competitive structure where if there is somebody who's basically creating a niche or a subsegment and dominated, those also sometimes we consider for investing. Now that's focus on the core. So some examples I'm covering here. Deep customer-centric focus to build sustainable competitive advantage. So comprehensive digital offerings for global BFSI. This is one of our holdings, Intellect Design Arena. The thesis was digital transformation. We invested somewhere in 2018, so pre-COVID. Digital transformation has become a buzzword post-COVID, but we invested as a part of our digital transformation thesis pre-COVID. It is like right now about 8x, and we have sold 25% of our holding. Global scale and quality CCL products. Manufacturing and R&D prowess, Gabriel India. High quality and high reliability Voltam transformers. Interesting. So what transformers were completely, some of the names you see here are, transformers is capital goods. So we would have, when we bought Voltam transformers, capital goods was a no-no, power sector was a no. But when we looked at this company and what we were seeing on the ground as a part of our thesis is that the entire power infrastructure in India needs to be upgraded. With the advent of data centers, with the advent of renewable capacities coming up, the need for transformers is only going to go up. So that was our clear opportunity that we could identify, and then we went and picked up Voltam. Voltam was the best managed company even in the power down cycle, where every other company was in duress and most became NPAs. Voltam remained zero debt. So it spoke for the quality and the kind of business that they built. So we bought Voltam, and Voltam is again now in last 3 years it's 6x in our portfolio. Raj, now another capital goods company, engineering company, we bought somewhere in 2019. Why did we buy Praj? We bought because when India became signatory to the Paris Climate Accord, how thesis building happens. We said now as a country we have to take decisive steps towards addressing the climate cause and reducing the carbon footprint. And amongst the things that we were studying, so we studied the advent of electric vehicles, we studied the renewable energy, how it's going to expand its footprint in India. One of the low-hanging fruits was the opportunity to increase the blending of ethanol in fuel from 5 to 20%. And policy for this existed from 2003. Our engines were ready to take 20% blending. Nothing had to be done. On top of it, the sugar industry was in a duress because sugar cooperatives and sugar companies, private companies, were forced to convert sugarcane juice into sugar. So the only thing that had to be done is that once the policy change happened, where the sugar, juice was allowed to be converted into ethanol, subsidies for new capacity creation came, the ethanol offtake prices were raised. We said now this is a breakneck, 4 times the addition of capacity in ethanol. Praj being the market leader, a solid company with a solid balance sheet, solid track record, all accreditations, we bought Praj. Again, when we bought Praj, capital goods company, historical last 5 years, sub 10% sales growth. Everything that you would see in a company which you will shoo away the company that this cannot be bought. We bought with the conviction that this company for the next 5 to 10 years is going to have a breakneck growth. Conviction came from the fact that this is where we could map the entire, how much new capacity has to come, what is the capex, Praj being a 50% share, market share, how much Praj can grab that, and all of that transformed into growth for Praj, nothing was available in the numbers, by the way. We bought Praj at 80 marks. Today Praj is, I think, close to 500. So you can see, and as we speak today, Praj is known everywhere. Praj is a buy. I have several buy reports. Everybody knows the ethanol story, and so many new entrants have come in the ethanol business. What we also, once we have invested, what we want to see in our companies, and we track them very closely. Again, on the ground, this tracking is not possible. We engage with the business's ecosystem on a case-to-case basis, suppliers, dealers, distributors, customers, former CXOs. I mean, yesterday I was here, I came here yesterday in the 4 meetings that I did. One meeting was with somebody who is a former CXO of a company we are investing in. So the idea is to know what is happening, what's the industry, So this is that private equity approach, where it is a continuous engagement with the business's ecosystems where we are investing. Sustainability, scalability comes, what are the parameters that I look for? So investments in people and investments in systems. So when we evaluate our companies, we do look at what is happening at the people level. Oftentimes, when you look at small caps, first generation entrepreneurs, it's very difficult for them to let go of and create a delegated, org structure. For us, it's very important to know that, okay, there is a second line of empowered managers which is being put in place. So that it can be either there or it is a work in progress, but the visibility of that should be important. That's very important for us. Similarly, in systems processes, we look at what kind of, for me, every company that grows to a certain level needs to migrate from a Tally to a SAP. It's only about companies who do it proactively, thinking of it as an investment for future versus somebody thinking of it as a cost and doing it reactively. That can make all the difference in terms of how much you can go and capitalize on the growth opportunity that's beckoning. Cash flow reigns supreme. For us, it's always about businesses being able to generate cash to fund their business rather than looking at equity or debt to fund their business expansion and growth. So where do we spend most of our time? So as I said, it goes beyond desk a lot. So I would say, hazard a guess, 1/3 of our time is spent on the desk. 2/3 of me and my team's time gets spent on the ground. And when I say on the ground, means talking to people. It could be even on video calls, but visiting facilities, meeting peer companies, meeting industry experts, participating or going and attending specialist trade shows, etc. So this is all private equity. Risks that can derail our investment theses, we understand and we are cognizant of that. Once we understand, we keep a very close check. So as an earlier speaker was highlighting that risk can come from anywhere. So yes, that's true, and that is where you need to first know what kind of risks at any given point in time businesses have, each business specifically. For example, when we invested in NOSIL was spoken about earlier. NOSIL was a 6x for us. It's only rubber specialty chemicals company. So NOSIL, when we were looking at NOSIL, we looked at several other chemical companies, not just rubber chemical companies. Few companies we were not comfortable when we visited their plants. We could stand there for like 10 minutes. There is so much of a chemical fumes which basically, so we clearly knew that okay, maybe there is a compliance on paper but not in spirit. Every factory which is running is compliant on paper, but we would like to see, given our long-term approach to and long-term horizon that we have for holding our investments, we would like to see. So with NOSIL, with Alkyl, we were very comfortable on that, for that aspect also. The management believed in environmental compliance in both letter and spirit. What are the red flags that we are mindful of? So we come across, as you know, small caps is a large space, a lot of companies, so we come across, and I won't take names, but we have been able to kind of avoid many pitfalls. Poor accounting policies and accounting inconsistencies. Managements who promise the moon but are disconnected from the reality and close to questioning. This is oftentimes when the companies are in a very high growth phase, we've come across. I mean, I would like to call them as, every market cycle there are some darlings of the market. They become darlings of the market, they promise the moon, but then, there is a huge disappointment later. Centralized decision making, one man shows, we avoid. Lack of focus, chasing too many opportunities and shifting priorities, no. Paper profits not converting to cash flows. Of course, we spoke about free cash flows. Conflict between promoters and promoter families. This is where especially the companies are belonging to certain business groups. And there, if we see and then promoter pledges. Risk, yes, we are mindful of risk. So we do look at risk. But for us, before I go to this slide, the two key risk mitigants when you invest in a small cap portfolio, one, buy a robust balance sheet. Don't buy a fragile balance sheet. All our companies have robust balance sheets. They can ride out any adversarial business cycle, any short-term hiccups, they can very well ride out. If it's long-term in nature, we will anyway consider weeding out that underperformer, weeding out that company in favor of another company. If there is something which is medium to long-term in nature and we feel that we need to do that. But they can ride out any short-term hiccups. No problems with that. So that's one risk mitigant. We also see that these companies, their promoters are also conservative. So when they take decisions, they don't take risky, rash decisions even with their businesses. So, unrelated diversifications, big bang, capex, they don't do. They generally are much more conservative. And they also don't get into cahoots with stock market operators manipulating their own stocks and playing in the market and pledging their shares. So one of the key risk mitigants also is kind of a governance and a hygiene check on the management and the leadership. The other one is that returns are a function of price you pay to buy the asset. Don't overpay. And that we do through our price guardrail approach, which I explained to you earlier. So it's a combination of buying robust balance sheets only at reasonable valuations using our price guardrail approach that has helped us contain volatility in an exclusive small cap portfolio whenever the markets have seen steep corrections. So our drawdowns relative to either the index or the peers have been much lesser, including post-COVID. And I don't have the data. I didn't compile that data, but Kamal can. They do compile all this data. They can always give it to you. So there is price volatility risk, illiquidity risk, portfolio concentration risk. So what is our belief? Rather than a risk, volatility actually can be a friend. On the upside, you sell if you see that there is a great opportunity to sell because we invest to exit. There is no there is no forever holding for us. On the back, downside, if there is that opportunity to buy because prices have fallen and fundamentals are intact, we will buy. Our price guardrail framework helps in preventing significant drawdowns, and we limit our exposure at a company and sector level. But of course, it doesn't mean that we will. So minimum we put 5% in any company, maximum 10%. So that's what we do. Some just success stories. Mrs. Bector's very early. After IPO, we didn't invest after the IPO. We found that company to be very expensive, but great business. So we did all our homework. We visited their plants, met the managements. We knew that after Britannia, there is a huge gap, and here is a company which is making fantastic products. So we waited. When it came within our guardrail prices, we bought in the region of 250 to 60 to 70 rupees, and from there it has then done very well. Tejas was our post-COVID buy. Now again, if anybody would have looked at numbers of Tejas in a post-COVID scenario, Tejas was sitting with a huge PSNL receivable. There was nothing really in terms of growth that was happening. What was the thesis? The thesis was that in a post-COVID world, where Huawei is being shunned all over the world by US and by Australia and all the US allies, here is a company which has the product which go into building that last mile bandwidth. and remote working would require enhancing that bandwidth into each home and each office. That's where the whole Thesis networks, we bought Thesis network. Great company with good people, nothing to worry, zero debt, despite all high receivables, no debt. We said if receivables is an upside. If it comes from BSNL, great. We didn't know that Tatas will buy it. That happened later. And now, of course, it's on another trajectory. It's actually now almost like it has the potential to become another Huawei in the world. Polymedicure is a healthcare devices company. It is our, big belief that what the pharma industry went through in the last 20 years before it started to face this headwinds from US FDA. We are at the same, as far as our medical devices industry, we are at the same crossroads. We are going to see a massive growth, both domestic and globally. Our medical devices companies will become very large. In the listed space, you will only find Polymedicure now. There are a couple of smaller companies which have gotten listed recently. We are tracking them, but they are too tiny today. But we will see in coming times a lot more action in this space. So lots of multi-baggers from time to time. These are, I have spoken about a few, but CDSL, we were very early investors. Mahindra Life Spaces, Canfin Homes, we were there. Now again, Canfin Homes, when we were looking at the same time, we were also looking at DHFL. And on many counts, DHFL looked more attractive. But because of this whole, wanting to go and question and seek answers, we didn't get answers on a lot of balance sheet queries that we wanted from the management. And we said that's a clear avoid. We would invest in Canfin Homes, which otherwise was like a semi-PSU, substantially owned by Canara Bank. So typically our portfolio comprises of alpha drivers, where you have nonlinear triggers for business and earnings momentum, and then steady performers, where you are historically you are seeing, and these are companies that are likely to grow consistently. Largely, we have been and we will be in these kind of sectors. So consumer discretionary always is there, tech is always there, financials is always there, healthcare, pharma, specialty chemicals comes in industrial. So industrials, you will see us invested there. From time to time, we may have some slight bias, but this is what are typically the sectoral representations of our portfolios have been from the day we started. These are the returns over a 11-year period. These are our returns on different timelines. So this is not our portfolio. What this slide is just there to tell you something which often we miss out. What if I told you that of the current Nifty stocks, 5 stocks were small caps just 15 years back? The 2 Bajaj twins, Eicher Motors, Shree Cement, Britannia. They were small caps just 15 years ago. Today they are in Nifty. So here is just a representative list of companies. These companies, so oftentimes when people say small caps are risky, the problem is that the good small caps move up the ladder. Some new ones join. So the universe will always look risky because the good ones are moving up. What is our desire? Our desire is that we should try and pick up those good companies which have the potential to jump the orders. Another question that comes is, are small caps, overheated? Have they gone berserk? Is it a high time that they will correct? At least the indices don't suggest that. There is still a big gap between small Nifty 50 and small cap 100 returns on the long-term basis. That's what this chart suggests. So it's basically, it used to be at 33% discount in December 2022. Right now the discount to Nifty is reduced to 23%. So our team, that's me, my two partners. This is our entire team of, so a very seasoned team we have been lucky to have. That's it. Thank you.
Companies forever, right? But that you have invested so much time with the management and you've gone to the next level detail of the fundamental analysis. Why not?
Okay. So the listed universe is a pyramidal universe. There are a large number of small caps. Few graduate to become mid caps. Even fewer graduate to become large caps. And some go into reform. When I invest in these small caps, and I should have told you, my definition of small caps is, when we buy a company, it should be between 100 to million to $1 billion of market cap, roughly 800 to 8,000 crores. Today, our average entry market cap is 3,500 crores. So we don't invest in tiny companies. As I was telling you. Now, when we invest, we create a portfolio. Trust me, every company we see that potential. But we know historically that it's not possible that every company will jump the orbit. They will fall off the cliff. They will perhaps go and then kind of get in a saturation mode. The leadership and the management also needs to continually become more mature, more dynamic to get there. So along the journey, not every entrepreneur will be able to make it. So therefore, the discipline, private equity discipline requires you to invest in a thesis. When the thesis is played out and is captured in the valuation, please sell. So invest to exit. Again, when I get the cash, I am running the engine. India is going to have the next 1 decade is going to be a decade of small caps, is my view, because a lot of companies are going to get benefited out of this whole world order is getting realigned towards India. While we have been all these years, we have been seeking, give us technology, give us investments. I am seeing for the first time, we are very early investors in aerospace and defense. And I have invested in aerospace and defense in my private equity days also. So very familiar with the sector. I remember that earlier we used to go and beg, please give us. Now GE and Safran are coming and saying, please take the entire engine technology. It's not happening just because we are asking to do, it's their need also. The supply chain disruption followed by Ukraine-Russia war is depleting the global ammunition inventory. It's a continuous war that is going on and nobody knows when it's going to stop. And because of that, there's a lot of supply chain disruption also because that region, Ukraine, Russia and the surrounding region was home to a lot of engineering companies, both sides. So my view is this manufacturing renaissance is going to continue. Then comes a tech. In the tech sector, we are seeing that from the services-led growth that we have seen all these years, now there is IP-led growth. You are having, a lot of the companies are still in the private domain, but the kind of growth and the kind of footprint that they are creating with their offerings is phenomenal. So these two drivers, manufacturing renaissance and technology growth, will spur consumption, be it real estate or be it your all discretionary consumption basket. So next 10 years we are going to see a breakneck speed. Whenever we are in such a phase, a lot of small caps who run their business efficiently get to that opportunity to grow in a non-linear way. Our job is only to have those 12 to 15 companies in one portfolio, not hundreds. I think if we ever create that big a portfolio, we will not be able to monitor. So for me, creating a 50 stock portfolio for the sake of diversification, which would mean compromising returns because I just can't monitor closely 50 companies. The way we monitor, we are happy doing that for a smaller number of companies. So that's...
Sir, you say private equity, it means before the company gets...
No. It's the private equity's way of thinking.
That's it. Okay. So
private equity approach.
Okay, private equity.
We don't do private equity. Right?
Sir,
Yes.
See, I can see the one time was you were one of the peak, right? So what time you exited the stock, or you still holding the stock?
Yeah, I'm still holding. You have not sold. We'll sell sometime in the next 1 year.
Well, like it's already become 5x, 4x for you, right? I mean,
So the thesis is very strong. It's playing out. That's what happens. That's how multi-baggers get created.
if for one become 2, 3, then you have to like at least like just to save the. Like suppose some downturns comes again or something.
Downturns may come. So we have bought at what, $800. Okay, 25% bhi niche aa gaya. We have the gumption to carry through. Again the upside will come. Don't to worry.
So
Because I am not overpaid to buy a company. No, I don't. I have seen. We have seen several such downturns in companies where, by the way, small caps, the best of the companies which checks all the boxes for me. Whenever there is a market fall, it can correct anywhere from 33 to 50%. These are companies which I desire to own. That's why you don't want to overpay to buy. You don't want to buy the momentum in small caps.
Well, actually, I sold for 3,500. I sold like last year, like December. I thought it's too much for that. Right? You are still, as a fund house, you're holding. I have a question.
Yes.
Since you have an extremely small number of stocks in your portfolio, how do you allocate new cash?
I told you, we have a approved list of stocks which we are currently investing in. So all put together across all our clients, today we have 26 companies. Any client holds 12 to 15 of these. So we have an approved list of stocks with a guardrail price. So a new client who comes in, these approved list of stocks, keeping the next 5 years we will buy. Now, if they are available within the guardrail prices, we will buy now. If they are not, we will wait for them to correct. So let me tell you right now, for new clients, our portfolio construction periods are about 3.5 months, because not everything is available within the reasonable valuations that we want. Go back to 2017, there was a mad bull run in small caps in 2017, second half. That time we took six months to construct portfolios of our clients, because most of our stocks were trading above our guarded prices, so we said we will not buy. So it's driven like that. So two clients who come in today will have the same portfolio. A client coming in today and a client coming in 6 months from now, of the 12 to 15 stocks, maybe latter client's portfolio may have 1 or 2 stocks which are different. Because in our universe, stocks move in few months, they double. When the time they will lie low, and one fine day the visibility of earnings and the growth comes and somebody takes a liking, it will double, or maybe more than double. So we don't want to that time chase momentum. We have our valuation guardrails that will always be there, and that has saved us the blushes in market downturns.
I have a question. So the AUM that you manage in this case?
500 crores is the AUM that we manage in the small cap. We do believe that this is not an infinite AUM strategy. We are very clear in our mind that at $100 million of AUM, we will not accept new money. So at 800 crores of AUM value, we will stop accepting.
The other question is, look at the performance charts. I think there's a dip in the 2-year chart. And
so I'll tell you, you will see the performance in 2018 and 2019. Small caps in general were punished for no fault of theirs. So it started with ILFS scam broking, that broke out, followed by DHFL, and followed by SEBI changing the definition of small, mid and large caps. So there was also that selling that came from the mutual fund industry to rebalance their portfolios. So that is the time where any small cap portfolio, if you segregate any multi-cap portfolio, just the small cap portion, you will see that in the portfolio. It was a little unusual because of sentiment. All small caps were branded as chores in that period, unfortunately. So that's the time when we bought Alpha, one of the finest specialty chemical companies. So those times, if they come again, one has to endure. So when I tell our clients that we take a 5-year view on our investments. So when you invest with us, don't invest if you have a less than 5 years. With folded hands, I say. Don't invest if you have a less than 5 years with us. Yes, sir.
How important is the cash flow conversion of the companies for you? Profitability to cash flow conversion?
Very.
I know you have mentioned about it in the presentation, but when you are saying that you invested in Tejas and the receivables were very high, the cash flow must be very low.
Tejas didn't have a cash flow problem. The receivables were high. They were not coming. It was an old receivable. Right. What they were running, they were making cash. They were not. If that cash would have come, they could have perhaps used that to put more in the marketing side, marketing dollars. They could have hired more. By the way, that receivable is still stuck. So we said, okay, let's remove this and now independently look at the business and what is it that the company does. Does it have enough cash to now, support the growth that is now, it's
So
going
lot
to witness.
of companies in the high growth phase, right? They are like they spend a lot of money on that gets stuck in the inventory or receivable, where the cash flows are, the conversion is probably 40% of the operating profit, or so you don't look into such kind of companies. Do you have a benchmark?
Yeah, so we don't invest in, like, for example, companies which are where the growth is balance sheet led, we will not invest. So we don't invest in EPC companies. It's not that EPC companies have not given good returns from a stock price perspective, but for us, we know that the EPC companies have to deal with the government. In the end, whether it's a state government or a central government or a NHAI or a PWD, you can't fight them. You will go to arbitration, it will take a few years, then that will be contested in the High Court. So you basically, on paper, based on the contractual term, it looks very good that this leverage will create high ROC and high ROE. But in reality, it never plays out. The cycle, when there is an upcycle, when there is exuberism, everything happens. So we say we rather not invest in EPC. We don't invest, so except Titan, which is Tanish, which is a big consumption grade jewelry, but we still are not comfortable with the balance sheets of all the other jewelry companies. So we don't invest. We don't invest in highly commoditized plays where there could be high growth, but it's so commoditized that the margin of safety in business is very low. So we will not invest.
So B2G companies you don't invest in.
B2G, okay, it is case to case. All aerospace and defense companies are B2G.
Absolutely.
Okay.
Absolutely.
There the cash flow cycles are, your counterparty is either Bharat Dynamics or Bharat Electronics or ISRO, then it's okay. The budgets and the way they work is very different. But if it is a PWD, no. If it's, so municipal bodies, no. So there are some caveats there. It's not a strict no, but very careful, and then look at the business and how critical is your equipment, how critical is your offering that you are making to the business. Because if you are one amongst many, then nobody bothers. You are the last person on priority to be paid by the government.
Thanks.
One question about the performance results again, which is since they are all like different portfolios depending on when you come in.
So SEBI doesn't allow us to give individual portfolio performance. This is the composite portfolio performance. So what happens is in our case, because the strategy and style is very different, so in the first 2 years, because we will, depending on the markets and guardrails, we may take our time to build the portfolio. Then our companies will take at least 3-4 quarters to show the fundamental changes that we have envisaged, which will get noticed by the market and the re-rating process will start. So first 2 years, we tell all our clients, talk about the companies more, less about the returns. Doesn't matter we are outperforming or underperforming. It should be more about the companies. It's as the portfolios get into that 3rd, 4th, 5th year and 5-year plus is when returns, what you see here, they basically converge towards that number. So variances could be 1 or 2% upper niche because basis the all long-term investors would have around the same. And then of course for individual clients it also depends on if some people have top down.
How it is okay. Cheers. What we should put it forward.
Any other question? Thank you, gentlemen. Thank you for staying away.